Hey everyone, welcome back to Capital Insights, where we make investing simple and exciting. If you are new here, don't forget to hit that subscribe button and ring the bell for notifications so you never miss out on our financial wisdom. Hi, I'm Jason, and today we are diving into one of the most fundamental yet often misunderstood metrics in investing, the price to earnings ratio or P ratio. By the end of this video, you will not only understand what the P ratio is, but also gain some unique insights that most investors overlook. Really, let's get started. The P ratio is a tool investors use to determine if a stock is overvalued or undervalued. It's calculated by dividing the current market price of a stock by its earnings per share (EPS). For example, if a company's stock is trading at $50 and its earnings per share is $5, the P ratio would be 10. This means you are paying $10 for every $1 of earnings the company generates. Did you know there are different types of P ratios? Most discussions focus on the trailing P ratio, which uses earnings from the past 12 months. However, there's also the forward P ratio, which uses projected earnings for the next 12 months. Each has its pros and cons. The trailing PE gives you a snapshot based on historical performance, while the forward PE can give you a sense of growth potential, but be cautious. Projections can be overly optimistic or pessimistic. Now let's dive into some lesser-known insights about the P ratio that can give you an edge. Different sectors have different average P ratios. For instance, tech companies often have higher P ratios due to growth expectations, while utilities may have lower P ratios. Comparing a tech company's P to a utilities P isn't apples to apples. Not all earnings are created equal. Companies can manipulate earnings through accounting practices like changing depreciation methods or recognizing revenue early. This can distort the P ratio. P ratios can be affected by where we are in the business cycle. During economic expansions, P ratios tend to be higher because investors expect future growth. In recessions, they drop as earnings decline and pessimism sets in. This makes it real with some case studies. Amazon has historically had a high P ratio. Why? Investors believe in its growth story. They are willing to pay a premium now for expected future earnings. But remember, this also means higher risk if growth expectations aren't met. General Electric, on the other hand, has seen its P ratio fluctuate dramatically due to changes in earnings and investor sentiment. This shows how market perception and actual performance can impact valuations. Here are some advanced tips that most investors don't talk about. Let's flip the P ratio and you get the earnings yield, EP ratio. This is useful for comparing stocks to other investments like bonds. An earnings yield of 5% means a company earns 5 cents for every dollar invested. The PEG ratio, or price earnings to growth ratio, considers a company's growth rate. It's calculated by dividing the P ratio by the earnings growth rate. A PEG ratio below 1 is often considered good, indicating undervaluation relative to growth. The Shiller P ratio, also known as CAPE, psychologically adjusted price to earnings, uses average earnings over the past 10 years. Adjusted for inflation, it smooths out economic cycles and provides a long-term view. Here are some practical tips to effectively use P ratios in your investment decisions. Always compare a company's P ratio with its historical PE, industry peers, and the overall markets. This context helps you understand if a stock is overvalued or undervalued. High P ratios are not inherently bad if the company has strong growth prospects. However, be cautious of paying too much for growth that may not materialize. P ratio should be one of many tools in your investment toolkit. Combine it with other metrics like dividend yield, return on equity (ROE), and debt-to-equity ratio for a comprehensive analysis. Let's recap. Today, we covered the basics of the P ratio, explored its different types, and dived into unique insights that can give you an edge. Remember, investing is as much about the journey as it is about the destination. Use these tools wisely, and you will be better equipped to make informed decisions. If you found this video helpful, please give it a thumbs up and share it with your friends. Leave a comment below with any questions or topics you'd like us to cover next. And don't forget to subscribe to Capital Insights for more investing insights. Thanks for watching and happy investing. See you next time on Capital Insights.